Hi everyone, welcome to the Financial Freedom Club. Another episode. We're going to hopefully add a bit of value. I'm forgetting what episode we're on. I'm sure the team will give me some input. I think we're doing number 4, if I'm right or not. And we're going to be concentrating on a really interesting area this time for all the entrepreneurs out there. It is around rental income and all the different strategies. So we're going to be going through a few things. Hopefully you can see the sign still, and the sign is all important. And what it is about unlocking financial freedom. If I can get out of the way for it. And what we're going to start doing. And do you know what? I'm going to get into it because it's August and I know everyone's itching to do a few things tonight. So let me get onto this fun. As I said, welcome to the Financial Freedom Club. And I'm going to share this fun here. So for the people who don't know me, I think everyone should know me, is Z Razak. This is the Financial Freedom Club. And we set this up to help entrepreneurs on that journey to financial freedom. What is the Financial Freedom Club? As I've mentioned, it's understanding all the different aspects that you need to work on in order to be financially free, and the compound impact talks for itself. 4 areas that you need to master. We're going to touch those, today's focus, and the Q&A, which I know everyone loves. Why people struggle to get financially free, and if you've seen any of the previous ones, I always go through this: not knowing the steps, secondly, not knowing how to implement the steps, and above is why we have set up the Financial Freedom Club. These are the 4 areas that a lot of the aspects that you have to master to really get the full benefit and get the journey and your journey on steroids to get to the end. Is you have to master personal finance, where we've been focusing a lot, then business finance, number 3, wealth and assets, number 4, retirement and legacy. And today, the topic we're going to be talking about, and hope everyone's ready for this fun, is personal finance. And what I mean by that is income from investment property in your own name. And at the end, we'll have a Q&A. Let's get into it. So I'm going to talk about different types of property strategies. And I know there'll be some questions from the audience around all the different ones. I'm going to focus on buy-to-lets. So buy-to-lets, for anybody, is when you rent a whole family home out, and the key thing is obviously to get rental income. Few things we noticed a lot of times, people don't know how to assess whether an investment property actually is worth the value that it should be. Because there's 2 ways to get value from investment property. Number 1 is cash flow, i.e. how much income are you going to get from investing in property. Number 2 is the capital appreciation over a number of years. Is the value of the property going to increase? And what I find is a lot of people concentrate on number 2, not number 1. To be honest, number 2, I personally think you shouldn't even think about generally. And the reason why I'll say that is you don't know if it's going to increase. You're going on historical trends. So what you want to ideally do is, am I going to have increase in cash flow? Because if you've got no cash, or it's costing you money and you don't know how to assess it, what do you think is going to happen? It's going to be a nightmare. So I've got this little example, and what I'm going to try to cover is 2 parts of buy-to-lets. Is 1, how much money do you need to put down? And number 2, what is the rental cash flow looking like? Very important aspects. So first of all, I've got a property. I know everyone will be like, depends where you buy it. I'll give you the classic here. I'm saying here that we're buying a property for £80,000. This is a property that needs a bit of work, and I was working out what would it cost me to buy it. Okay, very, very important part, because depending on your strategy, different ways of how to buy it. So if I'm buying this, I might buy it with the end in mind, because I know the value, if it's done up and it's looking pristine condition and that, it's 150,000 property value. But when I'm buying it, it's only 80,000. And then it's like, okay, how much do I have to invest in the property to get it up to 150k? This is an ideal scenario, by the way. Most of the time you will not have an ideal scenario on purchase, because the buying, i.e. when you buy it, is the key. Are you getting the property that is going to give you value after you've done work on it? And what I put in is a £20,000 refurbished cost. So this tells me how much I need as a deposit, and the rest of it I would, if I'm doing this strategy, I would do something called a bridge finance, which is you get short-term lending, say maybe over 6 months, do the work and then refinance out. And if I refinance, I'll get 75% of the market value, i.e. when I take a mortgage, and the mortgage would be 112,500. This is quite important to get this assessment of these points, that you know how much money is going to be left in the deal. So I haven't put in there how much money is going to be left in the deal. It's a simple equation, but a lot of people struggle with this. What it will be is this, the new value, minus the mortgage, and the difference. So how much I actually leave in the deal is my deposit less this. I'm going to move this out of the way. So actually in the deal, I'm actually only leaving, and I'm sure there'll be questions later on this, £6,900 if I was lucky enough. Apologies. I actually, yeah, I am only leaving, because what I'm doing is I'm refinancing the property and I'm getting 112,500 out. But if I add all the costs that I've spent, it's 44,400. So I'm leaving £6,900 in the deal. And this can change. So if I change this, you can see how much money I would have to buy the property in this example to actually work out how much I would have to leave in the deal. This actually, here is you would have to spend 30,800, but you would end up leaving the deal 1,300, because you're getting 112,500 out of after the mortgage. The mortgage, you're leaving 37.5 in, and you spent 38. So really, you've only spent 1,300. So you can get a property worth 150,000 at 1,300. Ideally, normally, I'll be honest with you, it's probably closer to this, or even probably closer to this. You've spent 100,000, it's cost you 50 grand, you're leaving 12.5 in the deal. Why is this important? There's a little stat that I'm going to go through later on how you evaluate it. On this property is then working out how much rent am I going to get. If I've got 150,000, generally on a buy-to-let, depends where it is in the country, you could get, say, 1,200. These numbers of rent are really important. The letting fee, if you're getting someone to let it out, is normally one of your costs. And that's 10 plus VAT, hence the 12%. The other cost that you tend to cost you is insurance, repairs and maintenance, I'll put 5% in, and the big one, mortgage interest. And I'm going to get onto some of the impacts of mortgage interest, because I know there'll be some questions on this, because the tax treatment in your own name, because this is rental income in your own name, is different to limited companies, and I know there's going to be a whole lot of questions, and we will go through that. So I'm going to recap the money that you need to get a deposit. If I bought a property for 100,000 and I spent 20,000 refurbing it when I knew the end value is 150, if I add my deposit plus the stamp duty, which is 3% for any property up to 250,000 for residential. Because what happens is that you pay the no stamp for the normal stamp at 250, but because this is a second property or more, you have to pay 3% stamp duty. This is England, by the way, so if you're watching this and you're looking at Scotland, Wales, Northern Ireland, especially Scotland, Wales, they've got different stamp duty details. You would have to change the equation and the thresholds. Always get good advice. So I'm just giving a rough idea. A £50,000 investment, after I've done all my stuff and refinanced full whack, I'll get 12,500. The key is, this is one part. The key part is this evaluation. And what I'm talking about is, how much is my rent? I'm going by market rent. Always put these numbers in, and you'll have access to these spreadsheets and things like this on the Financial Freedom Club website, which will be going live, and we'll have all this. I put 5% repair maintenance in. It could be more. How much the mortgage is, I'm doing it at 6%. I try to keep about a percentage over the base rate. Always try to get at the level what you think it's going to be for the next 5 years. I'm assuming a 5-year mortgage. And then you work out what the cash flow is before tax. This one works out quite attractive, because if I'm renting out, I don't have to pay the other fees that go with this. And I'm going to add those in so people know the cost that I'm not including here, because they are not relevant, because the tenant will pay these. Council tax, I'm just putting in about 200, it may be higher. But I'm actually putting 0 in, apologies, because in a buy-to-let you don't have to pay, because the tenant will pay these bills here. You would just have to cover insurance, letting fees, and any repair, maintenance, and obviously a mortgage. At these numbers, this property actually is quite profitable, because you're getting this. But I've also put an indication, if I was just doing buy-to-lets, how many properties would I have to get to a number that people band around is 10,000 a month, which would be 120 grand. How many would I have to get? I'm still going. So you would have to have something like 26 properties, which is a lot. So what I always say to people, when you're getting into investments like property, always start with something that's easy and you can see what it is first. So buy-to-lets are good to start off with, but that is your first step. Do not think that I'm going to do only buy-to-lets and I'm going to then get financial freedom. It's not going to happen, because you would have to buy so many, right? And if you think about it, scale, this is scale cash flow. What I'm going to then talk about is how much money would I've had to put in. I'm assuming that these are deposits now. I'm assuming the deposit stays the same. As we know, the property prices go up, so the deposit will go up. But let's assume it's the same. and I'm doing the same deal again because I got so good, I would have to put in £325,000 to actually get to 10 grand a month before tax, which is a magic number. And what I'm going to do is some, which isn't bad, because if I think about it, return on investment, I'm just basing this on cash flow, not capital appreciation, because you only get that when you sell it or refinance. If I do that, look at it still would be quite high. So on 26 properties, if I look at the money, so the buying is so important. If I actually bought this at market value, or I'd spent the 130,000, so it's actually cost me, look at how much this will all change. It would mean still good, because you don't get 20%. Go in the bank and try to get a 20% return on cash flow. It still can work depending on the key numbers. So the buying is so key. And a lot of people don't realize they overpay here, and this knocks out all the numbers here. I hope this sort of makes sense, the key thing. So 2 things. 1, how do I buy the property? Do I put a deposit down? And number 2, does it cash flow? Those are the 2 things that you need to think about when you get into investment properties. And you know I love giving value, so I'm going to cover a few other strategies off as well here, something called HMOs. And HMOs are when you rent out a property by the room. It's a total different model, because what will happen is that you will have to incur costs that you didn't incur before. So are they profitable? As everything, it depends on the cash. So if I got council tax on this one, which I'm going to put in, and I'm going to put in council tax of about 200. Because when you do HMOs, all the bills are included. So normally you charge a tenant. So I'm saying I've got a 5 property HMO. Let's go to 6, and we'll talk about some stuff later. This is how I make money. So if I rent that all 6 rooms out, the letting fees tends to be higher because there's more work to do. So I'll put about 15% away for that. I put 400 quid for gas, electric, 200 quid for council tax, insurance 50 quid, cleaning costs. You could, to be honest, they're probably lower. You probably could get away once a month. You could probably get up to almost £1,000 a month. And I'm using the same model. So I'm saying here, if I go back here, I generally think it's probably 100,000 you would probably get this. Let's do 100,000 again. I'm assuming all the costs are the same, and it's England again. But if you look here, the mortgage is still 75%. But now, if I do scale it, as I was talking about over here, and I'm going to be cheeky, put this all in here. And then I'm going to do the deposits again. And then we can play around to see how many properties do I need as HMOs to get here. 10. So I would need, based on these numbers, 10 properties to reach financial freedom if they're HMOs. I'll put some costs over here that are the general cost. I put a bit of repair maintenance. To be honest, this is probably 10% because when you do rooms, it is a lot more. So you probably need, say 12? Yeah, 12 properties. So we've gone from buy-to-lets at 26, good starting strategy, not for the longer term if you want to really grow your things, but look how much cash I need to put in. Buy-to-lets, I would need 325,000, 26 at using the same model. But if I look at these, I would need 12. Would I need 12? I've got to do what's left in the deal. Let me do this little work here. So apologies, I would need I would need 150,000. Wow, that's quite amazing actually, provided I get the numbers right. And these will cash flow about 800 odd quid if I've got 6 rooms. I've done a rent of £500 a room for 6 rooms. The numbers are key. So if I've got 5 rooms, I'm going to need a lot more. And the rooms become quite important. I will discuss that later. I just wanted to give an overview of what does this look like if I'm assessing. So one thing I would assess, number one, how much deposit I need, how much cash do I have to put up front, and then how much do I have to leave in the deal. And then the third part, which is, does it cash flow? This is how you assess whether a rental property is worth doing or not. And we will get onto some other aspects that you need to think about, but financially, this is how you evaluate. I'm going to get onto another strategy. It's called service accommodation. This is different again. This can actually get really good cash flow. And what I mean by that is, depending on where we're going and how we're renting this out, you know, you could potentially, depends on the market value, you could make quite big numbers here. It depends on how much you would get on a night rental. It is more labor intensive. I'm putting 150 in because if you're renting a whole house on service accommodation, you should be getting, I think, more than HMOs. I would be not bothering unless I'm getting substantially more because the amount of work involved. So I've done the same numbers again, and then I'm looking at how much do I need to leave in the deal. And leaving the amount in the deal, assuming the same amounts as this, I'll simplify it. I'm going to then do my little magic that we've done here to show how much does the scaling look like. You can see the cash flow is a lot more. If I say I do 10 properties, 8 properties, so about 9. So if I go through the different things, how much money would I need? So the return is just mind-blowing, because if I look at this, I'm only needing 9 of these. And I'm getting actually more than cash flow than how much it's cost me. There is challenges, obviously, of running one of these. I will always make sure that you understand. It may be that they won't give us the full 75%. Most of them do. It depends whether you do a commercial mortgage or a normal or regular mortgage. But you can just see the difference here. It's just mind-blowing how much cash these property strategies can do if you get the right property. So I'll go from 26 down to 12, down to 9, which is really interesting if what we're trying to do. Remember, I've not factored in capital appreciation, i.e. the property going up in value. What I'm doing is pure cash flow and whether I can have the money to do it. So you would need 50 grand cash running, but you would leave 12 and a half. So as soon as you earn 12 and a half, you go again. But it's all about how you buy, whatever strategy you do. So you could start at buy to let, do that, see how that works, then move to HMOs, then move over to service accommodations. And these property strategies, why I've gone through all these different ones is you've got to understand what impact they have. And I'm actually going up here to put 10% because this here would need more. It won't be like less maintenance, because the properties that are used more, HMOs and service accommodation, because they've got people coming in, moving along, they tend to have more repair maintenance. So you need to put that money aside. Yeah, and I'm just putting a number through for that. But if you look at all these different costs, you still can make money. The key is this number here. Does it stack up? And why I've put 75% is that you don't rent out the property all the whole 30 days. I know it's 31 days in some months, but I'm doing average 30 days times the 75. As you know, I do love my numbers, but this is a way to assess. So I'm going to remind everyone again quickly, 3 key areas if we break it down to the details. 1, have I got enough cash to buy the property? This is how much the deposit is going to be, right? I'm assuming bridge finance. You're not doing a mortgage, because if you do a mortgage at the beginning, you only get the value at what you bought it for. If you do a value after you've done the work, then your mortgage will be better because you get 75% of the new value. So normally people do a bridge. There is some finance costs. I haven't included them in there, but there will be some financing costs. But then you can basically get as much money out. Obviously, the one that everyone talks about is no money down deals, where you pull out and this is zero and therefore is infinite. In reality, I'll be honest with you, very few people achieve that. You can just see, look, even buying a property that's market value 150 at 100,000 is not an easy thing to do, but you have to, and then be able to then have some money to spend in the deposit. Deposit and the refurb. I'll put some stamped and legal fees in as well. I hope that makes sense, and we are going to get onto Q&A because I know everyone loves the Q&A. Let me get into the chat. So let's start the questions. What questions have we got for me? Really good question. Is there a difference between renting your main house out or a your main house compared to an investment property? Yes. The real difference is if I rent a room in my main house, I can claim something called rent a room relief. And this rent a room relief is £7,500 a year that I can get tax free. So if I rent a room out for £625 per month, I can claim rent a room relief and I pay 0 tax on it. And so I hope people understand your main house where you live, which is your main residence, you can claim this by renting a room. And currently there's no capital gains tax implications on sale because on one room. If it's more, there's issues. I hope that answers that question. Fantastic question to kick off. I think there is a little related questions for any. Oh, really good question. Read my mind. If we have a rental where it's a husband and wife, there is a different implication, and what the implication is that when you do a husband and wife, that 7.5 is split, or by two people for the same house is split £3,750 each. You can't claim 7,500 each. So I hope that makes sense. So the relief is cut in half. So you would have 3,750 on the husband's tax return, and on the wife's 3,750, or civil partners or partners who are owning that property that they're renting out. I hope that answers the question. Is there a difference rules to having a HMO or buy-to-let planning rules? Yes. Fantastic question. The reason why this is so important is if you have a buy-to-let, or sorry, you have a property currently, and I'm going to talk about England here because I know every council is different. What happens is you have a certain planning class. Most residential property, your main house or buy-to-let, is in C3 planning class. We're talking in August 2024 as we're recording this. That's the current state. If I do a HMO, which is a household of multiple occupancy, I'm renting a room, I have to change my planning class from C3 to C4. There's another part to this. Not only can I do that and can do it under something called permitted development and get the planning rules and get that done without an issue. And another challenge is that I have to check if I'm in an Article 4 area. Article 4 is, have they asked for formal planning permission, or can you just do it if you tick off the list? So you need to check that. The other aspect is, and you might have noticed I went up to 6 people. Generally, if you have up to 6 people, you can do it through a C4. If you go over 6 people, you have to apply for a different planning class called suis generis, which is 7 or more. Little tip, planning point, do not jump from 4 or 5 people to suis generis, you'll get rejected. You have to do it in stages. I hope that answers the question. Sorry, that was planning. The second part of your question was licensing. Pretty much everywhere now, you have to check with your council, is they ask for you to license the property as a HMO. And if you have to license it, you have to pay them a licensing fee. So you've got planning and licensing. They make money in every angle, so they got cleverer. I hope that answers that question. Wow, the questions are flying in. Yes, there is. The question is there any restrictions when claiming mortgage interest against my tax? If I buy a property in my own name, they call it the dreaded Section 24, tax on interest. So what happens is, I'm going to share screen quickly for 2 seconds to show it. So at the moment, it's just buy-to-lets and HMOs, but it will change as per July, end of July, on service accommodation, because currently that is finance costs can go straight into this equation. What happens here is it depends on my personal income in that year. If I earn more than 50,000 and I'm a higher rate taxpayer, 50,270 to be exact, as we speak in August 2024, I will not get full relief. I would only get like a tax credit of 20%. But if I'm paying tax at 40%, that's a problem. This is why I would always ask and recommend people to get an evaluation done on your mortgage interest before, and your property before you buy it, whether you should buy it in your own name or in a limited company, because it could change your decision depending on what you want to do. I hope that answers the question. What other fun have we got for me? Right, really good question. How do you finance property investment acquisitions in your own name? This is a very important part, and we have done some content posts. We had a mortgage broker answer some of this stuff as well, so do check our YouTube content for this. The big one is that there's certain criteria that they want to look at. So if I'm buying a buy-to-let or HMO or service accommodation, I have to show that the rental, okay, covers the mortgage repayment, assuming it's interest only, the mortgage interest payment. So I'll give an example. If my mortgage is £100 a month, right, and I'm a basic rate taxpayer, I earn less than 50,000, I'm going to have to show that the rent is at least £125 per month, which makes sense, because if I go here and have a look at some of these, you can see if my rent was only 125%, it's unlikely I'm going to make any money. So it actually is logical sense on this one here. If you can see 125% would not make me no money. So I would have to have at least £703 to even be able to get the full mortgage. If I'm a higher rate taxpayer, it's 145%. So I would need to have, I still could buy this because I would have to have £815 if my mortgage is £562. I hope that answers the question. That was a fantastic question. We're powering through these today. Is it better to buy it in a limited company or in your own name? Really, really good question. I touched on it earlier. It's the evaluation that's required. The evaluation is all about what your personal tax circumstances are. So I'll give an example. If I'm on earning income of 30 grand and I'm going to buy one buy-to-let, that's all I'm going to do. It may be better in my own name. The reason being is that income is a basic rate income. So I'm going to get full relief ultimately off my mortgage interest because I'm basic rate. And therefore not a problem. It's if I'm going to scale, then it's not a good idea to buy in your own name because the property income is taxed differently than other types of income and I can't control it. What I mean by that, in my own name, the tax write-offs, the government are restricted, like mortgage interest, how much money I can spend on the property and actually claim back, what type of cost there is. So it becomes not advantageous, and this has been the big problem for a lot of landlords who have bought in their own name. They've got hurt by this. I hope that makes sense. And I hope that answers the question. So limited company generally can be better, especially with buy-to-lets, HMOs. What happens if I want to sell the property? Great question. So if I got an investment property and I'm selling it to someone that is not connected to me, i.e. a relative, it will be subject to capital gains tax. One of the benefits of selling it in your own name is capital gains tax is actually lower than corporation tax and personal tax. Currently, as we speak, I have to emphasize this part, capital gains tax is 24% and 18%. 24% for high rate, 18% lower. It was 28%. This may change if the new government have different views. So you should always get it assessed and evaluated on your position. But there is benefits of selling because you get something called annual exemption. It is, as we speak, at $3,000 a year per person. So if it's a husband and wife, you would get $6,000 off the gain knocked off on the annual exemption, and then we would work out, depending on your circumstances, a lot of opportunities for capital gains tax, but it could be beneficial. But when you start buying more than one, it's better to have it in a company, because you can then decide on how much you take out, and there's more write-off opportunities in companies. I hope that answers that question. That was a great question. Right, really good question. How does property income affect your personal tax? So what happens with personal tax is your income is like layered, structured. And what happens is that in most cases, people don't realize this. So if I've got a job, that comes first. If I've got a sole trader, that gets put on top, and then property. And it can actually hurt you on certain different perspective depending on what your property income is, because there's not many offsets that you can do. So I can't contribute to pension and reduce my property income. My capital expenses for most properties are not tax deductible. So there's loads of write-offs that are not applicable for companies, and for individuals. So you've got to be careful, and that's why personal tax is disadvantageous property income in your own name generally when you get rental income. I hope that answers that question. Wow. Right, next one. Before I forget, another question before I go on to this one was about gifting. I did get someone asking me about gifting a rental property. When you gift rental property, it's automatically, generally, if it's to a related party, will be done at market value. So if I gift it to I'm excluding husband or wife between them, or civil partner, I'm gifting it to my children, it will always be done for capital gains tax as market value. The second tax that you've got to be careful is the person getting it gifted to, whether they have to pay stamp duty, land tax. And this is a very complex area. Always get advice. Generally is if I've got a mortgage, even if they don't pay me money, they have to pay stamp duty, land tax at the minimum mortgage, or how much cash they've paid for the property if it's higher than the mortgage amount. The third implication leads me nicely is into inheritance tax. So there's 3 taxes. Inheritance tax, is dealt with slightly different depending on how I do it. So if I gift it to my son, or son's the property, what will happen is capital gains tax will be due there and then. Okay, but if they've not physically paid me the market value of the property, it would also go part of inheritance tax. Can you believe that? And what that means is that that gift will be part of my estate for 7 years. After 7 years, that property will no longer be in my estate, and it will then be obviously in the children's estate. There is a lot of implications. Always get advice on whether it's right to you. I think there is a related question on this. I'm going to see what questions come up, and I'll try answering that as well. I hope that sort of explains. By the way, inheritance tax is 40%. And inheritance tax generally is the gross value of the assets, less the mortgage, less something called a nil rate band. As we're speaking in August 2024, it's 325 grand. Each person who owns the property that's given the gift. Right, can trusts help me? Yes, they can, potentially. They've been attacked over the years, and I think I was talking about it when we do our main residence. What we have to think about is, in a trust, how do we add value? And what I mean by that is, when I put property into a trust, okay, I can push, get a relief, hold over my capital gains tax, but there is an inheritance tax implication. And the inheritance tax is, if the value is more than 325,000 that I'm putting in, less the mortgages, I have to pay 20% inheritance tax, right? And then it says 7 years part of my estate, And then what would happen on death, if it happens within 7 years, I may have to pay more inheritance tax, or it just gets disappears after 7 years. What happens in 10 years, another important thing, I know I'm getting complex into, is in 10 years you have to review how much is in the trust. But a trust is a good way to pass property over, especially in your own name or in companies. We call them family investment companies. The reason being is you can decide later, if you change your mind, who gets it. And therefore, but if I do it a gift to an individual, they've got that property, I can't take it back. I hope that makes sense. There's also income tax implications to trusts as well as gifting from your own name if you still live in the property. Always get an evaluation, a lot of stuff. Has that answered the question? Is there any other questions? I know we've gone through loads. So I'm going to summarize on this. 3 things when you're buying property that you need to always work out. First, how much deposit? Secondly, how much money I'm going to leave in? Thirdly, does it cash flow? There is actually a 4-step. Where do I buy this property? Do I buy my own name, companies, LLPs, pensions potentially? How do I do them? Number 5, if I finance, probably have a little list. But these are the ways you've got to start thinking when you want to build your wealth as a and use property as the asset class, which I'm a huge fan of. But I hope that adds value and hope people understand what you need to do and hope they found value on how to assess the cash flow. I know we went through loads. This will all be on there. Is there any more aspects that anyone else wants me to cover? Otherwise, we can call it. Thank you. Is there anybody else need any other aspects? We'll record all this. No, I'm going to call it. So this will be recorded content. And if you're watching the recording, please look at our list that we're going to be doing with this to give you an idea how to implement all this. Use these as resources. Watch this video and watch it again and again. And hopefully that gives you the value. Thank you so much for attending. Have a lovely evening and take care. Thank you. Bye. How was that, Anya? Anya, how was that? Yeah.